Venture capital is a form of private equity where investors provide funding to startups with high growth potential in exchange for equity ownership. At its core, venture capital is about fueling innovation in young companies that are not yet ready for the public stock market. Most venture investments don't work out. Investors expect that only a small fraction of their portfolio will become highly successful companies. Beyond just writing a check, venture capitalists often take board seats to help founders steer the company toward rapid growth. Unlike bank loans that require steady interest payments, venture capital doesn't need to be paid back, but you do give up a piece of ownership. Companies typically raise capital in stages, starting from seed rounds to much larger series rounds as the business proves its model. Because these investments are illiquid, it can take years before an investor sees their money back through an acquisition or public offering. Thanks for watching. Understanding how businesses are funded is key to grasping the modern economy. Subscribe for more financial basics.